Hello, and welcome to the latest installment in our series on how fundamental analytics can be used to create individual and complex charts and graphs to help increase your margins and reduce your risk. If you're interested in taking a more in-depth look at our platform, please contact Mike Season, whose information is listed below. In order to access the Fundamental Analytics platform, you will need to go to fundamentalanalytics.com, click on New Platform Login, and insert your login information. After logging in, you get to the landing page with a choice of commodity groups. We will be choosing energy, and then we have various options. For example, let's choose crude oil. Once you're inside of the platform, you have three options: fundamentals, prices, and analysis. For this example, we will select fundamentals in order to look at fundamental data. You can then see the choices for fundamentals, and in this case, we are going to select DOE, which is Department of Energy information. As you can see from here, each box is a drop-down menu, and we will then choose stocks and then commercial. It is also important to note that you can look at this data broken down regionally. For this example, we will look at total US. This data has various features, including up-to-date information that you can find by sweeping over the line for 2019. You can then see the data for May 22, 2019, that was released the following 5 days on May 17th, and shows that there was 46.67 million barrels of crude oil in inventory for total US. By navigation, we can go to the years at the bottom of the screen in the legend and point to any year we want to see and highlight that data. The chart will automatically show you a default set of years. For example, this chart is showing back to the year 1982. But if you want to remove data, you simply need to go to the legend and left-click the year to remove it, which will automatically rescale the chart. If you want to bring that back, you simply need to select Show All Data, and then Remove Data will return. The current chart we are looking at is a year-on-year overlay, but anytime we have annual weekly data like this, we want to look at it from a time series perspective. In order to do so, you can simply click the time series box, and it brings up a time series of the same information from a different perspective. We can see how crude oil had very large inventories back in 2017 at the time of low prices, and correspondingly, we have been reducing the inventory until recently as prices have come up. Again, this is a simple switch between the two depending on what you would like to see. The data can also be viewed in spreadsheet format by clicking the data button and shows the most recent inventory. You can easily go back to the year-on-year overlay chart by selecting Chart. You always have the opportunity at any point within the platform to easily export the data into an Excel file or into a CSV. And you can also create a hard copy of the data by printing or downloading. Before we move on, we should point out that there are other choices within DOE information. We have been looking at stocks, but you can look at various categories of how they collect the stocks information. Crude oil including SPR, petroleum stocks excluding SPR, total petroleum stocks including SPR, and as I mentioned earlier, you can look at data broken out by various regions. Under the stocks category, there are a number of other options, such as production, which is of key interest recently with U.S. shale oil production. We will select Plot Data, and once again, it shows a year-on-year overlay with the latest available information. From a time series perspective, it is really more dramatic. We see how the shale oil production has changed dramatically since roughly 2015 and 2016. The points here where the data spikes down briefly are not data errors, but they're actually referring to hurricanes where production is halted. For example, we had 2 hurricanes in 2017, and this shows what happened during those weeks when offshore production was reduced and they evacuated the platform. Going back to the chart again, we will look at total U.S. commercial imports, which has been of interest because of the U.S. use of imported crude oil. As you can see, 2019 numbers are at the low because we are producing more, and we do not have to import as much. You can also draw in the 5-year average of the data to see where it is, and you have the option to isolate it as well if you would like to see it alone. Again, these are just simply switches that can be turned off if you want to return to the original data. This was just a brief introduction to fundamental data, and now we are going to look at prices. So we will select Home, then Energy, and Crude Oil again. Once we're inside the platform, we will be directed to the default option, which is Pricing. Within Prices, there is all sorts of choices of information relative to prices. One important feature is Instruments and Spreads. Again, we will be looking at crude oil since we're in the crude oil module, and the default is the July contracts. Selecting Plot Data will plot the July 2019 crude oil contracts, and again, the most recent contract is 2019. Now it is very common to do what we call calendar spreads. So we will click the plus sign back up at the top, and if the current contract is July, and we want to compare that to the next month, the August contract, we will change our second leg to August. In order to make a subtraction, we will change the August contract to minus in order to take the July contract minus the April contract, which we will call the July-August calendar spread between those contracts, so we can see how July is trading relative to August. Once again, hit the Plot Data button, and it brings up that calendar spread. We see it is pretty much in the middle of previous spreads, and we have a few extremes where the spread went strongly negative at the end of the July contract, like back in 2010. If you want to remove that outlier, it will realign and rescale the spread so you can see it better. You can also see another extreme case in 2009, so let's remove it as well and some of the older history. This way the user can easily see the most recent years, or as many as they would want by removing previous years and adjusting the scale accordingly. One other navigational feature, if you just want to start with 2019, go to the 2019 in the legend, hold down the Control key, and click it once, and it brings up just the 2019 data, and then you can back into previous years, 2018, 2017, 2016, and so on. Another feature in prices is open interest. Once again, the default is the July contract for crude oil. The July contract open interest for crude oil is plotted by a year-on-year overlay with days to expiration as the date axis. The default for open interest is 180 days to expiration, but in order to move in, we will change it to 50 days to expiration. By doing so, you can see that the open interest peaked back roughly 20 days before expiration. At roughly 500,000 contracts, it has been coming off since. What this allows you to see is when the real movement is as traders move out of their contracts. The point being is that within 10 days of expiration, open interest begins the decrease to zero, and the open interest drops dramatically, so it's rather difficult for a trader to get a good fill when you have so much movement like this of the open interest. The last thing to mention is spread matrix. What this does is show all the settles as of the day before, the daily change, and then this triangular matrix of numbers are the pairwise spreads. So you're looking at the June-July spread, which was at 14 cents. This was the June-August spread, June-September, and so on. So all of these pairwise spreads show how much the different contracts are pricing compared to one another. Now there are two pieces of information that we can add to this: the interest rate and storage costs. You can adjust these figures by going back to the top menu. Currently, it's roughly 2 cents a day to store crude oil. And if one does that storage, it's tying up money, so we have a placeholder number of 2.5%, which can be changed as we change daily storage costs. With these two numbers, we calculate the full carry, and we see that the June-July spread full carry is 17 cents to hold for the June contract to sell to the July contract. Currently, that June-July spread was 14 cents, so the percent to full carry, as we click here, is about 79% of the way to full carry. So this distribution of this triangular matrix table shows you the various percent to full carry. If the numbers would start to get close to 70 or 80%, That would signal to a trader that this would be a trade to look at, because once it gets to about 80 or 90%, it becomes a financial rather than a physical trade at the time. This was just a brief introduction to fundamental data and the various pricing information displays that we can do. If you would like more information, or if you're interested in a free trial or demonstration, please contact Mike Season. Also be sure to check out our website and follow us on our various social media pages, all linked in the description box below.